There are 4 key criteria that must be met in order for you to qualify for a zero down construction loan. So make sure to watch the entire video because each requirement is crucial to pulling this off. The first requirement is that the type of loan must be a construction to permanent loan, also known as an all-in-one construction or single close construction loan. This is a common type of construction loan that automatically converts to a regular mortgage after the project is complete. The obvious advantage here is that there's only one set of closing fees. A construction to permanent loan is available for primary residences and second homes. There may be exceptions, but most likely the property type must be a 1-unit, single-family detached home. There's no down payment up front, but you are required to make interest-only payments, but only on the money that has been incrementally paid out by the lender to your builder as they complete various steps in the construction process. For example, if you're approved for a loan of $500,000, but so far you've only spent $40,000 on the foundation, you'll only be charged interest on the $40,000 until you complete more of the project. A potential downside of the construction to permanent loans is that many of them can only offer adjustable rate mortgages rather than fixed rate mortgages. For example, my loan is fixed at 3.5% for 10 years and then becomes adjustable in year 11. I plan to refinance to a 30-year fixed rate mortgage long before my interest rate becomes variable, but it's definitely something to keep in mind and ask potential lenders whether their construction to permanent loans are fixed or adjustable rate. I can't go on without mentioning that not all lenders who offer construction to permanent loans offer a zero down option. You need to ask your loan officer upfront about the possibility of financing the entire build. And if a lender says no, then just call the next one. Oftentimes, a local or regional bank or credit union who knows the property values in the area you want to build is the way to go. Some of the bigger banks and mortgage lenders don't even do construction loans at all, let alone a zero down construction to permanent loan. The key is to not give up. The second requirement to pulling off the zero down construction loan is that you must already own the land that you want to build on. Whether you have a mortgage on your land or you own it free and clear, having already secured a vacant lot is necessary in order for you to build a house for no money down. Now, you can still build for relatively low money down even if you don't own your land yet. You'll definitely have to put money down on the purchase of your land, but the construction to permanent loan can still have no down payment required. It's important to differentiate that you cannot use the construction to permanent loan to buy the land, but you can absolutely use it to pay off or absorb any existing loan on your land. As I've mentioned, there are definitely ways to buy land with relatively little money down. In fact, I have a couple of videos on how to find and buy land if you want to check those out after this video. Basically, if you don't already have a vacant lot and you don't want to pay all cash for the land, then you're probably looking at putting between 20 and 30% down on a land and lot loan. But that amount of cash down on the land loan is still likely going to be way less than what 20 to 30% down on the entire build would be. For example, in my case, I used a land loan that required 30% down to buy a vacant lot a couple of years ago. I had been paying off the 15-year mortgage on my land until I was approved for the construction to permanent loan that absorbed my land loan. So the take home here is that once you own your land, you can then go and get a no money down construction to permanent loan to build your house and also absorb whatever you owe on the land. The third key to making this work sort of goes without saying, but I'll mention it anyway because it's extremely important. You have to qualify to borrow enough money to cover the entire build cost, plus any remaining loan that you have on your land. If you don't owe anything on your land, then you'll be able to put the entire loan towards your build. Lenders who offer construction to permanent loans use the same general debt to income ratio, employment, and credit guidelines as lenders who underwrite conventional mortgages for existing homes. It's extremely important to get pre-qualified or even pre-approved upfront in the very early stages before you commit to a design, builder, or anything so that you know your budget. Knowing your overall budget will allow you to determine how much you can spend on the build and cover any remaining debt on the land, and it will also help save you from any potential disappointment if you realize that you can't afford to build the home that you spec'd out originally. To help you out, your lender will most likely require that you have a fixed price contract in place with your builder, so you should definitely know your budget before you commit to anything. The final and most important key to getting approved for a construction loan with no down payment is equity. More specifically, the equity that you create in the finished property after construction is complete. The process I'm about to describe all happens before any construction begins. So, as part of the loan approval process, the future value of the completed property will be determined by an independent appraisal that's based off of the prices of recently sold newer builds in the immediate area near your property. The key to building a home without a down payment comes down to the difference between the appraisal value of the future completed property and the amount that you borrow with the construction to permanent loan. If the difference between the appraisal value and the loan amount is greater than or equal to 20% of the appraisal value, then you have basically just created equity in the property by building a new home rather than buying an existing home. That newly created equity is what essentially takes the place of any necessary down payment. Remember that this all happens before construction begins. This is all based on the theoretical finished property value. I know it sort of sounds too good to be true, but this is exactly what I'm doing with my second home that I'm building in Tahoe. This method absolutely requires that you do your homework and study the home values and square footage of the comps in your area. You also need to price out the construction cost for the home that you want to build. This means you have to interview and get quotes from several builders to find out how much you need to borrow to complete the project, and don't forget about soft costs like permits. If you can't realistically complete the property for 20% less than the value of the existing homes in the neighborhood, then you'll either have to look to build elsewhere or concede the fact that you might have to pay some level of down payment. To better illustrate how this strategy works, let's go through an example together. Say we owe $100,000 on a vacant lot that we want to build a house on. And we have carefully selected a builder after several interviews who has given us a fixed price contract for $700,000 to build us a 2,500 square foot single family house. The total amount we are looking to borrow to cover the build and absorb the debt on our land is $800,000. We have looked at all of the recently sold existing homes around 2,500 square feet in our neighborhood and found that they're worth at least $1 million. When the lender of our construction to permanent loan orders the appraisal of the theoretical completed property, it comes back at $1 million. Therefore, we have created $200,000 in equity just by building a new home. $200,000 is 20% of the $1 million value of the completed property, giving us a loan to value ratio of 80%. This means that we don't have to put down any cash for a down payment because we will already have 20% equity in the property upon completion. So thanks for watching, and remember that unfortunately, I am not a financial advisor. Have a great day.